Hey, what's up, everybody? It is Monday, Valentine's Day. Happy Valentine's Day to everybody. It is February 14th. Oh, yeah. Hope everybody's having a great day or had a great day. All right, let's talk about what's going on. Markets closed down a little bit today. We had a little bit of I don't know if we call it a scare or we got punked today. Again, more beating of the war drums. Market was doing okay, and then we had another warning that the United States was pulling out all of its embassy staff in Kiev and moving it somewhere else, and they were destroying documents and top secret stuff. All kinds of intrigue going on. And then I thought this was really funny. I don't know if all of you saw it, but the president of Ukraine, Volodymyr Zelensky, came out and said, yes, we're going to be attacked on Wednesday by Russia, but let's make this a day of unity. So you remember, this guy is a comedian by trade. I mean, he was a TV comic and he was elected president, and he definitely pulled a little comedic routine today I think he punked the White House and the Biden administration and the intelligence community. He said, "Yeah, we're gonna be invaded on Wednesday. Yeah, let's tell the whole world. Let's just put it out there with a megaphone. Vladimir Putin, we know your plan." Obviously, Vladimir Putin never read the book Sun Tzu's Art of War, because I don't think there's anything in that book that says, tell your enemy you're going to invade. Give them plenty of time to build up defensive, armaments and everything. And, just sit there on the sidelines, broadcast the day when you're going to do it. I mean, come on, folks. This is getting absolutely ridiculous. I mean, it's so obvious that the U.S. is pushing for something, anything to start in Ukraine so they could apply their sanctions from hell. The market's going to go nuts when that happens, but you know what? This is all a bunch of InfoWar stuff. I mean, it's being drummed up. The U.S. definitely wants to put these sanctions on. They want to stop Nord Stream 2 so Europe can buy expensive U.S. LNG. Come on, if you can't see this by now, I mean, I don't know what it would take to open up your eyes. Anyway, the markets are still moved around a lot, pushed around a lot by these headlines. But what else is new? What else is new? I mean, I've been talking about this headline trading behavior now for, I don't know how many years. I've tried to help you with this stuff. You got to go against this kind of emotion. Look, if it happens, it happens. We have no way of knowing for certain whether or not this is going to happen. I mean, the U.S. it certainly looks like it wants something to happen. It wants to instigate Ukraine into dragging Russia in, but we don't know. I mean, we don't know. So, and there's very little you can do to protect yourself. I mean, because it is a complete unknown and it's a crapshoot. We're not on the inside with Putin. Look, if you want to buy gold, if you want to buy oil, because if an invasion does happen, then we're going to get a spike in both of those things. You see the behavior of these markets right now. I would say that, looking at positions, if you look at the CFTC's commitment of traders that just came out on Friday, oil producers are still heavily long futures. And I've been talking about this for a while. And personally, I would not get bearish until I see them flip that position around. And they've been long now for, about 2 months. And that doesn't see, as a matter of fact, in the most recent report that came out on Friday, which was through the week of February 8th, they were the most long since, they've been holding a long position. They're long a net 58,000 WTI futures contracts, net. So that's long minus shorts. And as far as gold is concerned, I've been mentioning and sending out, at least to my subscribers, that gold producers are positioned very lightly hedged in gold. I mean, now this has been a factor for a number of weeks. They're very lightly hedged, which means their short position in gold is relatively low. I mean, so they must see some strong demand or supply constraints in the physical market. They're just not being very aggressive on the sell side. So both of those things, I think, would suggest higher prices for both oil and gold, notwithstanding what's happening in the Russia-Ukraine situation. I mean, in spite of what's happening in the Russia, even if that was not happening, I'm saying you'd be better off positioned, I think, long in both of those markets, just because of the way that producers are positioned right now. A lot of Fed talk still. By the way, Monday, today, I sent out the new issue of MMT Trader. If you're interested in an individual subscription, and some of you have contacted me, send me an email at mnorman@pitbulleconomics.com. I'll try to work something out for you. Right now, the market, Fed Fund futures are pricing in a 50 basis point rate hike in March. All right, and then May, June, July, September, October, and December. All of those months that I mentioned, the market is pricing in 25 basis point rate hikes on all of those months, and it's a close call even with November. So November is right on the edge of another 25 basis point rate hike. So 50 in March, then May, June, July, let's see if I got it right, September, October, and December. Rate hikes being priced in all of those months. And then in 2023, we're already seeing the markets price in rate cuts. So take your pick. I think, we had a first quarter GDP estimate of 0.7%. I think we're going to get higher than that, just because the fiscal flows in February are going to be very strong. I've been telling you this. We're going to see like a 640 billion month for February. I mean, you have to go back to July of 2021 to see a number that high or higher. Okay, so that's going to be a big boost from the February fiscal. March should be decent. April is tax month, so that's just normally a drain. And that's why if you've ever heard the old Wall Street adage, sell in May and walk away, that a lot of that is linked to the April drain from people having to pay their taxes, from us having to pay our taxes. So it leaves cash balances very low. The banking data was interesting. Loans were down, with the exception of consumer loans. I'm talking about credit card and revolving credit and automobile loans. Both of those things were up pretty sharply. It says to me that households are tapping credit lines, and that should keep consumption and retail sales at a pretty decent level. And remember all those inventories that built up in the fourth quarter of last year. And I was talking about that. We had a record quarter for inventory investment. If consumption stays high, if retail sales stay high, I mean, a lot of that inventory will be consumed, and that will translate, I think, into very strong corporate profits. They took a gamble. Maybe they didn't take a gamble. I think what happened was, because of the pandemic and supply chain issues, a lot of firms weren't able to procure inventory. They weren't able to get it. I mean, because of these supply chain issues. And then in the fourth quarter, when things started to loosen up, and remember, I was telling you about the rise in commercial and industrial loans. Those loans are primarily used to finance inventory. And I was saying, pay attention because we're going to see a big jump in inventories. Watch those loans because we're going to see a big jump in inventories. Remember that? And that's exactly what happened. We had a record increase in inventories. Now, they're going to sell that stuff as long as spending stays supported. And if I'm looking at credit card and revolving credit, it says to me that we're going to still see a high level of spending. So could have a bonanza. That could translate into a bonanza for corporate profits. The market's not paying attention to that. As a matter of fact, I think there's a lot of forecasts out there right now which are painting a picture of very weak corporate profits. So that could be a very bullish surprise. And again, we're dealing with a really negative, bearish sentiment environment. I mean, if you look at the put call ratio, if you look at the AAII weekly sentiment survey, lots of bears, hardly any bulls. The market seems nervous about everything. I mean, it could either it's the Fed, or it's interest rates, or it's the pandemic, or it's war drums going on. I mean, there's nothing out there that people can really look at and say, oh, this is positive. But, that's the kind of environment, I think, that create very interesting buying opportunities when sentiment is really, really negative like that. Look, I wouldn't be saying this if we had fiscal flows that were going down. I know in January I was talking about the surplus. And I got all wrapped up in that surplus, thinking, I was extrapolating that out over the remainder of the fiscal year. But then, boom, we turned around big time in February. Market is very, nervous. Sentiment is very bearish. Everybody's afraid. Fed rate hikes. They're gonna do taper. They're doing taper. They're gonna reduce their balance sheet. That's actually a bullish thing. Like most people don't understand this, but I mean, we've gone through this period of massive reserve additions into the banking system, and that was a hindrance on lending. So, I mean, you reduce that, and I don't see that as being negative at all. I mean, I see that as being a positive, especially now when you want to have credit supporting the economy. I mean, you need to see that. So that's going to be a good thing. But don't expect to learn that or to hear somebody say that from, the mainstream economics community or the financial media. They're just going to tell you, oh, that's a tightening. They're taking away the punch bowl, yada, yada, yada. So that's it, everybody. That's the update for Valentine's Day. Hope everyone's having a great Valentine's Day. I'll be going out in a little while, taking my sweetie out for a nice dinner. And I'll see everybody tomorrow. Take care, everyone. Bye-bye.